So before we discuss today's topic of SoFi stock-based compensation, as many of you have asked for my opinion, I will quote Anthony Noto's closing remarks from third quarter of 2021 earnings call. Planes don't fly, tanks don't roll, and guns don't shoot without people. So one of the biggest asset any company can have is people, and biggest liability a company can have is also people. It's all about the people, folks, and that is exactly what we'll discuss today. There is a lot of noise about the stock-based compensation for SoFi. Some seems this is a total greed, some sees it as a part of business, and some sees this as stock manipulation. So let's talk about all of that, and I will share my views with everyone about their stock-based compensation. Please note these are my views and they are not reflection of what the company is doing or what's going on inside. So let me share a few stats and then I will share with you my part of the research. Now, if you enjoy videos like this, then give this video a thumbs up and also subscribe to the channel and take advantage of 5 free stocks when you sign up with Moomoo using the link in the description and a guaranteed NEO stock. It's a pretty good deal, and of course it's a commission-free trade, so it's a pretty good app actually. I like it. Okay, so now let me share a simple chart and then we will go over a few things that I would like to discuss with you. This is a chart that compares all other companies with SoFi on their stock-based compensation. And if you see over here, this picture doesn't look good. SoFi's stock-based compensation is 24.3% of the revenue as compared to these other companies, which is only 8.6% for Upstart, 8.2% for Lending Club, and I'm going to quote PayPal here. PayPal is right around 5.4% for PayPal. So if you compare these 3 big names with SoFi, we can see that the stock-based compensation or the percent of the revenue is really high for SoFi. Okay, now what I would like to do is I would like to bring this quote from their recent earnings report. It says, this is what the management says. The last thing to cover on guidance is our stock-based compensation expense, which we currently forecast to be between 80 million to around 85 million for the Q1 of 2022 and 340 million for the full year, which is of course much higher than 2021. So their stock-based compensation is much higher in percent of their revenue as compared to other companies. Why is that? Okay, now if you pay attention, let's actually come back to the revenue. Revenue growth 1 year percent is 74.2%, which is, if you compare with the other numbers, it's not good. If you pay attention to Upstart, they had 263.6%, Lending Club 157.4%, and PayPal about 18.3%. Okay, so let's talk about this. Why SoFi is offering so much stock-based compensation as compared to percent of their revenue as compared to other companies. If you go back and look at any of these companies, just go back and Google for, let's say, Lending Club acquisition or Upstart acquisition and PayPal acquisition, you will see that SoFi acquired one of the biggest companies as compared to their revenue that they're generating right now. I'm not comparing PayPal and SoFi together here. I'm comparing more like Upstart and Lending Club with SoFi because, of course, they are newer companies. PayPal is an old behemoth, it's like an old company, and things were different back then. We are talking about in today's market. You will see that SoFi has been the most aggressive in acquiring other companies. See, Lending Club and Upstart, they belong to a certain sector. They are not a all-in-one financial app that SoFi is trying to be. So SoFi has acquired or made 3 acquisitions in the last 2.5 years. They acquired Galileo first, then they acquired Golden Pacific Bank. Don't forget, they acquired the bank, and there's a huge expense in being a bank and transferring yourself into a bank. Then they acquired Technisys, which was very recent, for $1 billion. So if you look overall, they have acquired 3 big names or 3 big things that has happened in the company. And anytime an acquisition has happened, it results in more employees added, it results in more operational cost, and it results in more managing of people. It's very basic knowledge when it comes to business that anytime you acquire a company, not only you are paying for the company, but you are also paying to include or incorporate that company within your business model. There's a huge expense for that, and one of the main expenses business has is people. So now let's take a look at what their impact on the net margin due to stock-based compensation. So if you go back to Q1 of 2021, we can see the fluctuation here. If you continue to go back, we can see by fourth quarter, their net impact was really high. Why? Because their net percent to the revenue is also very high. So they're not only adding more and more people into the team, but of course their cost of stock-based compensation is going up. And I will actually share my research why this is all happening. So one thing is very clear, that SoFi is very aggressive in terms of acquisitions, in terms of expanding, in terms of basically adding more services to their platform as compared to Upstart and Lending Club. So to compare SoFi with, let's say, Upstart and Lending Club, it won't be fair in my opinion, because again, they are in a very, very selective I would say business model. They are not going for all. They are only going for a selective business model, which is a great approach. I'm not against that. I mean, Upstart being in the auto is amazing. They acquired one company, a software company, but it has only to do with auto. They didn't go and acquire a bank. They didn't go and acquire a Galileo type back-end company. They didn't acquire Technisys, which is front-end and back-end. So there is a lot going on with SoFi as compared to other companies. PayPal's revenue is huge. PayPal's member is huge. PayPal has been around for a very long time. They don't have to throw carrot in front of people to come and work for them, because they know that PayPal is a very stable company. All these startups, like basically SoFi, I consider that as a startup, SoFi, Upstart, Lending Club, they really have to convince people to come and work for them, because people want to feed their family and kids and they want to have a secure job. They don't want to be out of the job 3 months after joining the company because the company raised their hand and they went belly up. So these are the things that is affecting a stock-based compensation. Along with that, take a look over here. So this is from LinkedIn data. Now, of course, LinkedIn data is not most up to date. There is a lot more that happened before or behind the scenes with the company. But you can see that this is the number of total employees that SoFi has. This is all SoFi, by the way, this right here, the facts that I'm showing you. So they have about 9% growth in terms of their employees in the last 1 year, and I will show you in the last 6 months, and 20% growth in 1 year and 38% growth in 2 years. For a startup, this is very minimal. This is not a big deal. But don't forget, this is SoFi's internal employee growth. It doesn't account for how many employees they are going to bring with Technisys, how many employees they brought over from Galileo, because that's all a part of the company, right? You're working for Galileo, or you're working for Technisys. When SoFi acquires, now you work for SoFi. So their actual growth is much higher. Along with that, take a look at new hires. In the last 3 months, since January, look how they shot up. They shot up big time, and now in March, we still don't have the final numbers, but you can see in March right here, we have seen a decline in hires because, of course, they were getting ready to become a bank. They were hiring Technisys, so all this. And this right here is top management. So you can see that they have kept hiring top management every few months to manage the business that they have acquired, because again, you need good people to manage people. Now take a look at this. This is their total job openings right now. They have about 184% job opening in the last 3 months, which has grown up from 37% before. Look at finance, 583% increase. They are hiring more financial folks right here. And financial folks knows how this game works, and they demand for better pay and better stock-based compensations. Then we have human resources, 142, and a total of about 137% in the last 3 months as compared to 70% in the last 6 months. So they have really aggressively hired more people in the last 3 months as compared to the last 6 months because of the recent acquisition and them turning into a bank. So they have acquired a lot more people in the last 3 months. Right here, you can see right here as compared to the last 6 months, because last 6 months their growth have been muted because they have hired a bunch of people over here in the March of 2021, and then in May of 2021 and July of 2021 right here. And then after that, they aggressively hired more people in the first 3 months of 2022 because, of course, turning into a bank and turning into a financial hub, or turning into more of a, I would say, a one-shop or one-stop shop for all. So my opinion is that I'm absolutely okay for SoFi to offer these kind of stock-based compensation in the short term. I am not with them if they continue to do so in a year's end, because I feel that we need to, with the recent acquisition we will see their effect in the balance sheet this year by the end of the year. And then their hiring and, of course, their acquisition, if they do any other acquisition, that's a different topic. But if they acquire, if they stop the acquisition and they just focus on growing their business, then this year's 2022's stock-based compensation of about 340 million will be one of the highest they have had in a while. Now, if they acquire another big company, again, totally out of the question here because we don't know what's going to happen. So I feel like this should be a top line number for SoFi going forward. From here on, they should be able to manage this cost better. Along with that, they should be able to increase their revenue better, because now they are a bank, now they have Technisys, now they have Galileo. So they can increase their revenue better and come into the range of about Lending Club, I would say around 100% or 120% going forward. And that is going to help in reducing this number right here. What do you think about their stock-based compensation? Let me know in the comments below. I know that we all have our views and I would love to find out yours. I'm excited about this stock for the long term, but we will see pain in the short term and there is no avoiding it. Like my last video, I mentioned how badly shorted this stock is. I plan on buying SoFi more in the coming months to bring my average down. I'm not buying right now, but in the coming months, I'm going to add more to bring my average down. As I told you, my average is about like 15.30 or something like that. I would love to bring it down to about say $10. And now some housekeeping items. I'll be traveling to Florida from this Saturday the 19th to next Sunday the 27th for a business conference and then taking kids to Disney. Wish me luck. I'm the least person to go on a roller coaster. I love parks, but rides not that much. Well, I don't like heights, let's put it this way. Okay, so I won't have many videos coming out, but we'll do them as and when I see something worth to share. As always, thank you for being here. A pleasure to share this with everyone. Until next time, you all have a sparkling day.